Are markets richly valued today? Is your equity portfolio poised to handle today's market scenario? Does Solitaire do it better? Measure, analyze and respond. Solitaire's secret sauce is here. Join us for a webinar on Saturday, the 4th of November at 10 a.m. to know more. Registration link in description.
We are back to our conversation with Subra. We spoke in the previous video about what happened in small cap from a past perspective. Now in this video, we are going to talk on the topic making sense of small caps, the future. Subra, we spoke about the past, we spoke about what happened in these 3 years, how we made all those returns, how those returns need to be seen, and how one must calibrate his own behavior towards investment success in small cap, which has been quite extraordinary. In this video, let us position ourselves about how we must see the future, because I think that positioning oneself towards the future is a very core ingredient in small cap investing. It's not just about companies, it's about what kind of a portfolio you will build for the future, how you will build that portfolio, over what time frame, with whose help or guidance or management, and how you will manage yourself during this phase of ownership. So what are your thoughts on how a small cap investor in mutual funds or in that one ETF should position himself from here? What should an investor first start thinking? How should you prepare for the future?
So I see the returns that you get in the market is increase in PE and increase in EPS. So when you are at the nadir in both and both go up, you get the best returns. So assuming for a minute that you do a control alt till of what has happened so far, you are starting on a fresh slate today. The PE is already maybe at 17, 18, maybe higher, but maybe it will fall to 18 or that's it. Over the next 3 years, don't expect too much of gain on that front. I mean, your 18 can go to 21, 22. That's not really something to write home about, and that's all it will go. And there would be maybe 3,000 stocks to pick for small cap. So small cap is far more difficult to pick for you as an individual, and doing reasonable sizing. If you put small amounts of money in many small cap, that may or may not work. So small cap is one place where you will be better off with the guidance of a fund manager. So your expectations from today has to be something like 11-12%, because everybody is talking of a 9% growth in the economy, etc., which has not happened. Our best of times we have done at 8.5 or something. So 9 may or may not happen. So even if 9 were to happen in the economy, for you to get 12 is going to be difficult.
You are setting an expectation of 12% as the upper end of the range, when the current range is between 20 and 33. Exactly. Is that right? So actually more than halving the upper end, the range on the upper end, and your the lower end you are reducing it by half. Is that correct?
That's right.
What is the rationale behind that?
Okay, the thing is, your economy is not going to grow at 20%, 25%. So your portfolio cannot grow at 20-25%. When we are talking of say a 10-year period or a 15-year period for your growth to happen. Rates, the R drops, when N increases, R drops. That's very the compounding formula. You cannot keep on saying I will compound at 18% for 30 years, 40 years. It doesn't happen. Warren Buffett, or don't take those examples. Even Buffett, the N is huge, R is 12 or 13. So don't think your 33% is ever going to sustain. 2-3 years it can sustain. Another thing important is in a 10-year frame or a 12-year frame, unfortunately or fortunately in equity, especially in small cap equity, the first 2-3 years may give you so much return that the next 7 years may give you nothing.
Correct, that has happened.
That has happened before, and it is bound to happen in any way, any portfolio that happens.
By our logic, if earnings doesn't grow at the rate which market expects, even this 9-12 can become even lesser in the near term, temporarily. So just like you had 33, you can have a lower number also. Is that
Yeah, yeah. This is, see, 12 is this number. The swing can be this side or this side. You have to be ready for it. In fact, if it goes down and you're young, you should celebrate because you're getting more units at at better prices.
So you're saying use that opportunity.
Use that opportunity to buy and not to feel bad that you expected 33 and you're getting 7. It can happen. It's not going to happen. So have your expectations set sensibly. Don't expect any growth in the PE to happen. Even if it happens, it will happen very slowly. EPS growth can happen. The worst thing about small cap or best thing about small cap is one small cap can grow at 30% and one small cap can grow at 0%. It is the fund manager's skill to create that portfolio of 70, 80 stocks and maybe even 115 stocks in which he will decide which is value, which is growth, etc. It's very difficult for you to do as an individual.
Let me extend a little bit of what you have said. You're saying that business performance in small cap will not be secular. There'll be massive divergence. There'll be directional divergence. Some companies doing very well and some companies doing very badly. So in a portfolio, it is the manager of the portfolio who has to ensure that he has more of the winning ones and less of the losing ones, because you cannot completely avoid either. So the mix has to be some 65-35 or 70-30 or 60-40. More rights than wrongs. And the investor must accept that. Is it possible for an investor to do this on an individual basis? Can I, as a small investor with some 2 lakh, 5 lakh portfolio, actually manage to do this by following 20 people and doing it in my portfolio? Because a lot of people have success doing that in the last 3 years. Is this something sustainable for the next 3 years?
I don't think so, but what happens is some guy gets lucky and say, look, I did it, but he could be the exception. So if you're asking me out of 10,000 people, how many will get it right? Maybe 100 will, maybe 500 will, but as a percentage, it is not something with which I will make the rule. For 9,500 people, they're better off going with a good, competent small cap manager, and believe me, there are many of them. Today there are very many good fund managers who have done a very competent job.
Yeah, there are good managers, I agree.
Good fund managers who have done a...
In fact, I want to clarify one thing. I have been making multiple cautionary videos on small cap. The reason I was cautioning was because the flows were making the manager behave in a way which is uncharacteristic of him, because he was compelled to buy. Also, the valuation zone in which the flows are happening was not comfortable to me. By virtue of this, even a competent manager was being pushed to the margin or the brim, and I was fearing that he would topple over in performance, which is now happening. It was no statement on the competence of any of these people, because it is not easy to manage small cap in the way that many of these people have done, and I only have respect for what quite a few of them have done. Having said that, I want to point out something and ask you specifically on that. 10 years back, small cap fund was 3-4,000 AUM, 3-4,000 crore assets under management. Today it is 30 to 45,000 crore. Even assuming that it loses 30% and there are some redemptions, this 30 may become 20, right? Or 45 may become 30 or 35. Do you still think that these managers will be able to repeat the performance in the next 10 years on such a high base of capital which they manage, which they have managed to do in the last 10 years? Because a lot of people are going by 10-year returns and saying that for 10 years you can invest small cap. I am a very patient investor. I am a distributor who is only with patient investors. There are a lot of these people who have this confidence. But is that confidence aligning with the actual challenges of the investment management in those products? Can you be in a 30 crore or 20,000? Can you be in a 30,000 crore or a 20,000 crore fund and still do as well as you did in the last 10 years over the next 10 years?
See, doing well over the next 10 years, you will have to redefine rather than say, will you get 24% return over the next 10 years? That you won't. 99% you won't. But if you say, okay, if India grows at 9%, if inflation is 7%, so will you get 15-16%? The answer is yes. To that, yes, they will be able to do. The reason is the opportunity for the small cap fund is greater than one for the large cap. The large cap has only 100 shares in which to buy. So a large cap fund buying 70 shares, it's like buying the index. There's no point in. So a large cap guy has to focus on 20-25 scripts or maybe lesser to get good returns. This guy still has scope to buy 140 scripts and get good returns. So I think he will. And I don't think any of these guys are going to put more than 4%, 5% in one company. They understand the risk. So I think they will be able to do. I think there will be opportunities as India's growth happens and the number of people coming into investing happens. If you see the success for India is this 15,000 crore monthly SIP book. And there is no reason why that 15,000 crore can't go to 30,000 crore over the next 3-4 years. There is no reason, simply because more and more people will be reached out to. Number of SIPs will increase. I'm sure the mutual fund industry will hit bigger numbers. So I think the funds will continue to get money. During a bad time, they will get money. So fund managers will get opportunity to buy. So I think doing well, they will repeat. Will they get the same numbers? It may not happen, but it is also possible that over the next 10 years a large cap may outperform the small cap, because it's not always that the small cap will do well and large cap won't do well. That the other thing can happen.
That was the other point I was coming to. That was my next point. That is, I have a certain discomfort about 1/3 of the SIP book being in small cap. I think it's disproportionate. So one of the two things can happen, and your last point could be a directional indicator of that. That is, the SIP book can go from this 15,000-16,000 progressively to 30,000. The small cap book may still be 5,000 or maybe 7,000. So more stable products will get bought into by the incremental SIP investors. Those who are coming now or from now may go for something more stable than go into small cap. This is my reading. So that will probably give more stability to that SIP book, because I feel that whenever people go too much into an SIP based on past returns, their behavior will not sustain and their conviction won't last. So they tend to stop after 1 or 2 years. This has been the running narrative on SIP. At this time also that can happen, but the overall participation in SIP may not reverse. That is my sense. And since it won't reverse, and since you have these 6 crore people who are having 10,000 rupees or less in their demat accounts, I see no merit in their running a demat account with 10,000 rupees or less worth of shares, because they'll pay huge demat charges. It's crazy. And they don't even calculate how much they're paying these brokerages as demat. They're only happy they're not paying brokerage. Whereas it's a proxy income for the brokerage. So these guys are better off with no demat charges, not using demat itself to buy a mutual fund, and probably doing SIP in a better place. So I think those guys will come in and probably stabilize the SIP book with a more longer term view and not necessarily chasing recent performance. Now to another question that is going to bother the investors in small cap in the future. In several funds which have performed dramatically, we are seeing a change of fund manager. I will not name, because my intention is not to highlight those fund houses. It's for the investor to check whether the fund manager has changed in his fund. But fund manager is going to change in several small cap mutual fund schemes. Somebody who has done very well in the last 8-9 years, for him today exiting that role is very good, because he can use the goodwill of the past performance to start something on his own, collect money, go to another place and start afresh and all that. Because he knows this scheme, which is done exceptionally well, is going to lag in meeting the expectation of investors in the future. If an investor is invested in a scheme where the fund manager is going to leave, what should he do? How should he deal with the new fund manager? How should he deal with the investment? How should he deal with the gains which are sitting there notionally? Can you tell something about that?
The big fund manager change which we have seen has been HDFC, because HDFC largely we saw it was
in small cap this is happening now in at least 2-3 other fund houses.
It looks very difficult to prejudge a new guy. It's like, what happens if the new guy is better than the old guy?
I agree, but what do you do with your investment?
You just change, see what he is doing, and see how he's doing compared to the whole industry.
But if everything is going down, the poor chap is going to first start with the underperformance, right?
he is going to start with the underperformance, but you have to understand some other small cap may be underperforming more. So if you want to be in small cap, don't change because just because a new fund manager has come in. You wait for some time, see how it is, see what changes he is making. So suddenly a fund manager will come and say, oh, you had 140, I'm shrinking it to 120 or 95, and if he's giving you good results compared to what the industry is doing.
So you're saying even if he falls less, stick to him. You don't have to make positive returns. That is your point.
Doesn't have to, because you don't know how he's going to react. And what if he's already been an analyst in the same fund house who is upgraded because he's been doing the similar job. So I don't think you should prejudge a guy even before he comes and say, oh, I should get out. No, wait for some time, see how it is, because many fund manager changes which we have seen have been reasonably well and stable. So I don't think.
Now I'm going to ask you the next question. Should I be in a 40,000 crore AEM small cap fund or a 2,000 crore AEM small cap fund? How do I decide that?
Largely, we believe that the 2000 crore guy has more maneuverability and therefore he'll generate more alpha. But there is nothing to say that the 40,000 guy will not have a similar advantage. All his knowledge, all that is going to help. So, unless there is very specific proof that the 2000 guy is far more competent and is doing well, in fact, I would think the 40,000 rupee guy has more cushion. He will be more cautious. Yes, he may keep little more cash, worried about drains and all these drawdowns. He may be worried. This guy may not have to keep. So this guy could give you better returns, but maybe with a higher standard deviation. That guy will be worried about standard deviation because he'll see a greater drawdown. So 40,000 crore guy will be more conservative than the 2,000 crore guy.
That's a very interesting point you're making. You're saying that the bigger guy will move with more caution. So in a market like this, maybe it's not a bad thing. So you have to look closely. Okay. And what do you think of a small cap fund manager continuously buying the same stocks because he gets money? Because he may be holding the valuation up.
Yeah, that's a risk which you will never be able to find out in the market where he has got only 3% of the stake. So you have to find who are the other shareholders. Are they weak? Are they private investors? Are they the family itself? Is there any big change going to happen in the family? Is the family split happening if it's a big family held? Or is it FII? Is it other shareholders, other individuals, other mutual funds? So based on the shareholding of the companies in which he has invested, he will have to act. And I think fund managers know all this. So they are also cautious that they won't keep on, if they put 800 crores in a company, it may be just 4% for him or 3% for him. He knows beyond a particular level, he may not be able to exit so easily. So he will also then press the brake and not keep on pressing the accelerator. I think most of these fund managers are competent. The boards are competent. They're supervising, especially after some issues happened in other fund houses. I think boards and trustees are now more.
No, that directionally is improving continuously. And I don't see things reversing the bad way. I don't see that happening. Now to the question of whether you should buy a small cap fund ETF. A small cap ETF, or should I buy a actively managed? Active versus passive. This is another argument because in the need to be innovative, fund houses are coming up with numerous products. Do you think that it makes sense to buy an ETF over a actively managed fund in small cap?
See, depends on what you have done and what has worked for you. In the micro cap fund, which has also come. Now the question is to put money in micro cap. Will you remove from small cap and put in micro cap, or will you remove from large cap and put it in micro cap? These are questions which you have to answer. What level of fund management you want to do? If you put it in ETF, you are going to get that ETF return. Only question is the cost that you save. If you put in an index, small cap index or a mid cap index, you are going to get the returns of the index. If you think the fund manager can create alpha, which I think they will be able to over the next 3 years, I would stick to a fund manager rather than go to an ETF. I would do that. But yeah, if I have 100 rupees, maybe I'll put 20 rupees in ETF also and 80 rupees here. And slowly, if I find that the fund managers are not doing as well as the ETF or as well as the index, I will slowly shift. But I'm not in a hurry to shift.
Now to another question. A lot of people have tasted success in small cap investing through the small case route. But what I have noticed is when you put money in small case in a portfolio, it gets bought in one go. There's no waiting, no order placement,
Nothing staggered.
no staggered. So a lot of small cap returns in many stocks was contributed by the recommendations made in the small case. So a lot of small cap volatility was manufactured in the small case system. Going forward, I feel that this will come under very intense scrutiny. It has to. What is your advice to investors who went to small case, overlooking the small cap ETF or the small cap mutual funds, active managed funds? What are the risks that they are running from here? And what are the safeguards which the small case investor must take?
Small case, there is no guarantee of liquidity, right? He is just saying this is my small case portfolio. So then it is the individual stocks that you are buying. Will you get liquidity in everything? Will the liquidity shrink? Will newer money keep coming into that? Those are the risks that you run. Whereas in a small cap fund, you know that it has got an SIP book of 500 crores. You know so much, at least even if they get a 500 crore redemption every month, they don't have to worry because the SIP amount is coming. In small case, if further buying does not happen, then will you get liquidity? Will you get a chance to exit? It is not as though small case is investing in HDFC Bank.
Also, if some guys sell, if a few HNIs sell, the small cap investor will be like a batsman who ran for a run and the non-striker didn't move. It can become like that, that is.
You run, see, small case, you run all the risks of direct equity investing. It is direct equity investing without any rails or safety rails or guard rails to protect you. Only a guy who knows how to invest in direct equity should go to small case, because see, this is my worry, that it is easy to create Facebook group and WhatsApp group and keep on bidding up Telegram channel and bidding up a share. You don't even know whether the guy who is bidding up is selling or whether he is buying. You don't know. What if he is selling and you are buying?
Also, when it reverses and the bidding down happens, you have no response whatsoever.
In small cap, in small case, you could find only seller for 4 days in a row.
Correct. So
and that all your gains are wiped out. You're down to your capital, because it is not that as though you bought HDFC Bank or Reliance that it won't hit a lower circuit and stay there.
No, many are actually.
These small companies will stay at the lower circuit. You would have seen the price of 127. You would be anchored at 127. You will actually get an exit at 93. Because it has fallen that much, and then you say no, now it will go back, you will wait, and then you could completely be ruined. So I don't think this is a very easy thing for people to do. They think, oh, I can just buy this portfolio, I save 1% or something. Yes, it will hurt.
But impact cost is more than this 1%. No, that is, I don't understand this logic at all, that small case is cheaper. The impact cost is multiple times more than whatever is the.
Yeah, if you don't get exit at all.
TER is relatively less than impact cost. Both sides, if you include, probably TER will be 1/5 or 1/4 of the impact cost of small case.
You take just as an NAV, if a fund has an NAV of 127, you will be able to exit at 127. Right? Maybe if it falls, you will exit at 126. You will not have to exit at 93. This kind of a fall in the NAV of a small cap fund is not likely to happen, that it falls 40% by the time you exit. Whereas you can see a 40% fall in a single share, and that time if the other shares are also falling, you don't know which to sell first. Should you sell which has fallen 40% first or something which has fallen 10% first? Because the 10% one is giving you liquidity, the 40% is not giving you liquidity.
It's giving you pain.
It is giving you pain, you're not able to exit.
Now to the pacing. How should you pace your investment in small cap over the next 2-3 years? This is a very, very critical thing for most people.
So first of all, to get good returns in small cap after this fall is going to take time. So if you're planning an exit before 5 years, don't even think of coming here. So yes, you do a SIP or an SGP over 2-3 years. If you're doing an SGP, do it over 2 years instead of doing it over 1 year. But start doing, and then you find it is going down. You put more money into it, and then wait. And then do your regular SIP after 2 years or 3 years, but don't be in a hurry, because the market gives you enough time to make money. I don't know why people are in a hurry to make money.
So your conclusion is, from here, play small caps like a tortoise. There is no upside in acting like a hare right now. the markets are going to take a lot of time to consolidate, to reevaluate the right valuation zone for small caps, and once they fix that zone, which should be a lower one than what it prevails today, the markets can further take time to assess when the valuation zone can move upward, when the range can move upward. The valuation zone may even move downward further if fundamentals change, if global sentiment changes. So the watchword is caution, and the pacemaking is slow and steady. On that note, I want to thank you for this very interesting conversation, Subra, and let's have more conversations on different segments of the market as we see them today and as we see them in the future. Thank you very much.